Welcome back to the channel. Today we've got a video and this is going to be on personal finance basics. So this is going to be kind of base level stuff, nothing really too in-depth here, but we hope you find it useful and interesting. So our agenda, we're going to go from checks to accounts, so savings, checkings accounts, retirement accounts. Then we're going to look at credit score, how to invest, budgeting, then insurance, taxes, and debt and loans. So first up, we've got accounts. So we're just going to kind of look at the different kind of accounts. So a savings account is designed for storing money while earning interest on the balance. So this is typically used to hold funds for short-term goals or emergency. So you have probably heard someone say, like, how much do you have in your savings account? So this is what that's talking about. This is where you put the money that you're not intending to spend like immediately, like at a store or something, but it's the money you want to save and you want to earn interest on. And then we've got a checking account, which are mainly used for everyday transactions like paying bills, making purchases, and accessing cash. So, like, this is what you're going to use if you're just buying some stuff at the grocery store or a video game or something, is your checking account. That's what you just buy your everyday items with. And there's no interest earned on this, and there's no, like, money taken out of it or anything. It just stays the same. So, most, like, younger people like me, I only have a checking account. I don't have a savings account. And then a retirement account, which is meant to save and invest funds for a retirement, which can ensure financial security at an old age. So you put money in this with the idea that by putting money into this, you're setting yourself up in the future to have a set amount of money when you retire, which will help you just with mindset of budgeting. Yeah, so that's. Let's look at credit score. So credit score is a numerical representation of a person's credit worthiness, indicating how likely they are to repay borrowed money based on their credit history. So like if I have not paid back any of my debts before, then it's most likely that I'm not going to pay back this next debt. So whoever is I'm asking to loan me that money, they're not going to want to loan it to me because they don't think I'm going to pay it back because I don't pay back my debts. And lenders use this to assess the risk of lending money to an individual. So banks, credit card issuers, and mortgage providers, those are like some example lenders who would be looking at this. And so the people who calculate your credit score are credit bureaus. So some of these that you might have heard of are Experian, Equifax, and TransUnion. Or by a scoring method like the FICO, which stands for Fair Isaac Corporation, or Vantage Score. And usually these are between 300 and 850, with 850 being the best and 300 the worst. So the higher your credit score is the better. And so some of the kind of factors that affect your credit score are your payment history, your credit utilization, the length of your credit history, the types of credit, and new credit. And this is, sorry, didn't mean to do that. This is important because it just plays a big role in determining whether you can qualify for certain loans or credit cards, the interest rates you'll receive, and the credit limits that they will be willing to extend to you. Okay, now let's look at checks. So checks are written documents used to instruct a financial institution to pay a specific amount of money from the writer's account to the person or entity named on the check. So that's kind of too many words. You need to describe what it really is, which is it's a piece of paper that says you're giving this person money. So you've probably handled a check before, you've seen one. So people have checkbooks, which are their checks. So when the bank gets a check from someone's checkbook, they know that it's from that person. And so they write it out to you if they're giving you the check, and they say what it's for and the amount that they want to give you, and you turn that into the bank, and the bank takes the money from their account and puts it into your account. So there are different parts of a check and different types of checks. So parts of a check, there's the drawer, which is whoever writes the check. The payee, who is whoever is getting the money from the check, whoever the check is addressed to. The amount, which is how much money. The date. The memo, which is where you can say what the check is for, and the signature, which is the person who writes the check's signature, which is basically saying, this is me, the bank, you can take my money and give it to this person. And some different types of check are personal checks, business checks, cashier's checks, traveler's checks, and certified checks. I don't want to dive too deep into this just because I don't want to make the video too long, but those are just some types that you've probably heard of, and we can do more videos on this if y'all want, or you can just do some research and find out what the difference between all those is. And so kind of the check process is that when the payee deposits the cashier check, the recipient's bank sends it to the drawer's bank for payment. So that could be the same bank or it could be different banks. The drawer's bank verifies the signature and ensures sufficient funds are available. So they make sure that the person who wrote the check actually has enough money to have written that check and to deposit that check. And then the funds are just transferred from the check writer's account, the drawer's account, to the payee's account during the process. And sometimes it can take a few days, but usually, at least in my experience, it's pretty much instantly. Once you turn in a check, the money's in your account and they give you a little receipt and you go on with your day. There's also a lot of security kind of considerations with checks because they're kind of pretty vulnerable to fraud. Like if you just take a check from someone's checkbook, fake their signature, then you've kind of you have kind of you can kind of take money from them, which presents a pretty big security issue. And then other considerations are features like watermarks, microprinting, and security threads, which are used to kind of deter fraud because those are things that like only the banks can print and make. Yeah, so some alternatives to checks are electronic payment methods, just like debit cards and credit cards, and also online transfers like Venmo, Cash App, PayPal. So now we're going to look at how to invest, and I don't want to make this as like why you should invest or the steps to invest. This is just literally how you invest because like personally, like a month ago, I had no clue how I would actually invest money. Like I'd heard of the apps, but I didn't really know kind of what what a company that you invest your money through, what some kind of examples of those are. So some platforms are traditional brokers, online brokers, and mobile apps. So a pretty popular mobile app you've probably heard of is Robinhood, and there's also Webull and M1 Finance. So you've got your online brokers. You've probably heard of E-Trade, and then you've got TD Ameritrade and Interactive Brokers, and then your traditional brokers, which are Charles Schwab, Fidelity, Merrill Edge. You probably heard some of these names before, but maybe you didn't know that they were platforms for investing, but that's what they are. And one thing that's kind of important to keep in mind is to become knowledgeable before you start investing. Investing is kind of like you're basically gambling your money that a company is going to become more profitable, or in the case that you're shorting it, become less profitable. So you really want to make sure you kind of know what you're doing. You don't just want to start investing in, hey, look at Apple, they're a huge company, I'm going to invest in them. You don't want to just do that without knowing what you're doing. So now let's look at budgeting. So budgeting is the process of creating a plan to manage your money and allocate it. So the concept is pretty simple, but there are a lot of steps when it comes to budgeting. Like the concept is pretty simple. It's just keeping track of your money and stating what you want to do with it. So, but the steps, there's a lot of steps. So you want to track your income, list your expenses, which you have fixed expenses, variable expenses, and periodic expenses. You want to categorize your expenses so you can kind of group them like housing, transportation, entertainment, food, savings, repaying debt. Then you want to set financial goals. So you want to make sure and you're keeping in mind what exactly the goal of your budgeting is, so that you can kind of use that to, I guess, make sense of what you want to do with your money when it comes to budgeting. Then you want to create your budget, so you just allocate a specific amount of money to each expense category and ensure that your expenses do not exceed your total income. Like obviously you don't want to spend more money than you have. That's just basic finance. And there's something called the 50-30-20 rule as a guideline, which is 50% of your income for necessities, 30% for discretionary expenses, and 20% for savings and debt repayment. So necessities would be like the water, electricity, Discretionary expenses would be like Netflix, maybe Hulu subscriptions, and savings and debt repayment. Those are self-explanatory. Savings and then repaying debts. Say on a you were loaned on a house. And then you want to monitor and adjust. So after you create the budget, you want to monitor it to make sure that you're actually following that budget, and also to find out if you're not following that budget, to kind of be actionable about that and try to get in the mindset of following that budget. So you want to just track your spending, adjust your budget, and review your budget. So now let's look at insurance. So insurance is a financial arrangement that provides protection against potential financial losses or damages. Involves an individual or entity, the policyholder, paying regular premiums to an insurance company in exchange for coverage. In the event of a covered loss, the insurance companies compensate the policyholder according to the terms of the policy. So an easy example of this, that definition is kind of long, but is life insurance. You might have seen those crime shows where someone dies and right before someone took a life insurance policy out on them. That means they are basically betting. Betting is a strong word for it, but that's kind of what it is. You're betting that you will pay. I'm making a video. Please just stop talking. You're betting that that the amount that you're going to pay per month added up over time is less than the amount that you are going to get if that insurance policy hits. Or hits is, in the case of life insurance, would be if that person dies. So there are lots of different types of health insurance, lots of different types of insurance. So you've got health insurance, life insurance, automotive insurance, homeowners insurance, disability, travel, liability insurance. You might have heard of some of those before. And then kind of how insurance works is, first is the premiums, which is what the policyholder pays regularly to the insurance company. And they're determined on things like coverage type, risk level, age, health, and history. So I guess a kind of example to show how this would work would be a person who is 70 years old is going to have a much higher chance of dying than a person who's 30 on average. So that's going to be factored in. If you're taking out a life insurance policy on someone who's 70, it's going to be more expensive than someone who's 30, assuming all other things are equal. And then policy terms is the policy outlines what the details are, what's covered, exclusions, policy limits, and deductibles. And the deductibles are the amounts the policyholder must pay out of pocket before the insurance company covers the remaining costs. So I guess like if your house gets robbed, you might have a deal that you have to pay $500 to get everything reimbursed. So you would pay that $500 and then you get everything reimbursed. And then you've got claims. So when a covered loss occurs, the policyholder files a claim with the insurance company. The insurance company reviews everything that happened and determines the payout based on the policy terms. And then you've got the payout. If the claim's approved, the company compensates the policyholder for what they determine to be the covered loss, the amount that that loss was worth. And this can cover the full cost or a portion of it. It just depends on kind of the policies, policy limits, deductibles, a lot of different things. So now let's look at taxes. So taxes are mandatory financial charges imposed by governments on individuals, businesses, and other entities to fund public services and infrastructure. So they're a primary source of revenue for governments, and they're used to finance a lot of different functions of the government, like education, healthcare, defense, social services, and public safety. And you've got lots of different types of taxes. So you've got income tax, sales tax, property tax, payroll tax, estate tax, a lot of other ones. And there are a lot of pros and cons to taxes, so that's what I'm going to kind of talk about here. You probably can understand what the different types are, like sales tax is what you pay at the store, income is what you pay out of the money you make. But I guess the pros and cons are sometimes less obvious. So the benefits are public services. They help fund these public services like education and infrastructure. Social programs, they also support social welfare programs like social security, Medicare, unemployment benefits, and like food assistance. Another benefit is economic stability. So these provide resources for the government to invest in research and development, which can stimulate economic growth, and also the redistribution of wealth. This can be a pro or a con, depending on kind of how you view this, but progressive tax systems can help reduce income inequality because they tax higher earners at higher rates. And obviously, if it's funding these social welfare programs, that money is going to kind of go back to the poor class. So, some cons of taxes, though, is complexity. One thing is just tax codes are complex. They require a lot of careful planning and professional assistance. And what kind of goes in with that is that compliance is another con that can be confusing and challenging for individuals and also businesses. So, like a lot of times, maybe you've heard of someone like hiring someone to do their taxes. They do that because doing taxes is a kind of complex process and requires a lot of just time in general, a lot of time to go through. Another challenge is fairness. So there's debates over if taxing, for example, like we just talked about progressive tax systems. So if a progressive tax system is taxing the rich more than the poor, is that an ethical thing? Is it fair to tax the rich more than the poor? Um, and with the goal of redistributing wealth, or is it unfair to the rich because you're taking a larger proportion of their money to give to people who some might say don't, quote, deserve it? Another challenge is evasion. So, tax evasion is illegal non-payment, and tax avoidance is legal strategies to minimize taxes. They can undermine the effectiveness of tax systems. So, you've probably heard of this. They say that a lot of rich people evade taxes, and usually they're not evading taxes; they are avoiding taxes. So, tax avoidance, and people have a lot of different opinions on if that's fair and kind of should it be allowed. So our last slide we're going to look at is debt and loans. So I'm going to make this short just because I've kind of went over the time I wanted, but debt is the money borrowed by one party from another under the condition that it will be repaid, typically with interest. So it can be incurred by individuals, businesses, or governments. So our government is many trillion dollars in debt. You might have heard that before. That means we owe other countries money. Usually we owe them more than what we borrowed from them because of that interest. Because it makes sense, right? Like intuitively, if you borrow $100 and you're going to pay it back a year from now, it does no benefit to the person lending you the $100 if you just give them $100 back. So they make you pay interest. And so some types of debt are consumer debt, business debt, and government debt. Um, Yeah, and then we've got loans, which are sums of money borrowed from a lender, typically a bank or financial institution, which must be repaid with interest over a specified period. So some types of this are secured loan, unsecured loan, and specialized loan. Um, yeah, so